Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Brynne Kelly. Remember, new shows are posted on Mondays and Thursdays. You could subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, FTSE Russell, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on futuresradioshow.com. Today I spoke with the founder of the Fundamental Angle and head of research at Cornerstone Futures, Brynne Kelly. Brynne tells us what she is focusing on right now in the natural gas market, why she uses the 3 C's: constraints, cash market, and conditions. She talks about how crude oil prices have recently been impacting natural gas prices, her process for trading natural gas spreads. She comments on some of the recent natural gas headlines coming out of Iran, and last but not least, Brynne gives her thoughts on CME Group's newest futures contract, physical LNG futures. So without further ado, let me take you right to the interview with Brynne. Brynne, given what happened in natural gas last fall, what do you look for when framing up this winter to position for potential rallies?
Well, it's really tempting to look at outright prices, where they're trading, where they're at right now, relative to what we saw last year. And just, for a quick refresh, it was really this starting around this week, over the next 4 weeks last year, that we saw that infamous run up that we had in natural gas, where we went from $3 all the way to above $5 in a really short period of time, and there was a lot of news written about that. And so here we are this winter, and we've finally gotten through the summer, and we've got prices. Natural gas prices have just cratered through this summer, and I think they're sitting around $2.25. And on face value, I think a lot of people might just look at that price level and get a little anxious and think, like, how much lower could it go? I'll just grab some here, and we'll have that big run up. And I think what I wanted to do is just kind of talk a little bit about the things that I'm looking for before I would jump in and do that. And there's kind of 2 ways that I'm trying to approach this. One is on a macro level, and the other is on a micro level. And I'm going to talk much more about the micro level. And I kind of call it the 3 C's that I'm looking at, and that's constraints, cash markets, and conditions. And by conditions, I mean weather conditions or storage levels. So if you look at, or you think about the natural gas market, really it's a seasonal product, with divided into summer and winter. And the winter season begins in November, and that's the current futures contract on the board. And so many of the moves that gas makes in the winter are binary moves. It's either yes, it's going to rip higher because of something, or no. And most of this is due to constraints, and those are deliverability constraints. At a high level, if you look at the natural gas market, we have certainly enough nameplate storage capacity to get us through our regular winter season. And really, even on a daily deliverability basis, we have enough macro capacity. I think it's 120 BCF a day overall capacity of deliverability. But when you get down into the nitty-gritty details, it's a regional market, and depending on where weather hits, there can be constraints in one region or one part of the country that can blow natural gas prices, in these regional markets up to $100 plus. And that's the big ticket move that tends to pull the Henry Hub central location along with it. However, this year we're sitting pretty comfortably in our storage levels, especially relative to last year. We have, I think, 18% more in the ground than we did this time last year. And that matters because we were at such low levels last year that there was fear in the market. Even though on a macro level, everybody generally believes that there's enough supply out there, and there will be enough supply for a long time in the future. But on a daily basis, and last year going into that winter season, there was an underlying bid in the market because the forecast was for a really cold winter, and storage was comparatively low. And what happened was that when prices started to move, the mentality of, end users, and we'll call those, the utility companies, was to buy now in order to preserve what they had in the ground. And that was exploited by, the move in the futures market. But the first indication of that was that daily cash prices were really strong all through, the summer and leading even into shoulder months where there's not very much demand. So now here we sit this year, and we don't have that underlying bid. The perception is for a normal winter, and we have a normal amount of supply that we've built up in against the backdrop of record daily production. So in order to really get and make a bull case, we need to see one of those regional constraints show up. And bottom line, in the winter for natural gas, it comes down to demand and it comes down to weather. And given that backdrop right now, there isn't enough fear to exploit that and move it up into the futures market, even though they haven't seen it in cash yet. And we're sitting here with really, really weak spot prices across the country. It's the lowest demand of the year, and we're seeing producing regions trading $1.50 lower than the $2.25 that Henry Hub is trading. So these constraints are, they're not here yet, and there's less fear of them this year, right or wrong, because nobody knows what winter is going to look like until we get there. And then we have, as I mentioned, sort of the second C, which is cash prices. And that is where we can't get any traction because the daily price every day across the country of where, buyers and sellers are clearing the actual physical delivery just keeps getting weaker and weaker. And especially in the big producing regions where, like in the Permian and up in the Appalachian region, their prices when they trade so significantly lower than Henry Hub, you know that there's excess supply and there isn't enough demand to pull it to the market. And so really it's just gas on gas competition. And right now in the spot market, it's really just like the lowest price gets picked up. So, we don't have, any evidence of constraints yet, and no fear of that. The cash market is not supporting, showing any signs to get excited about. And so then we have to kind of look at, well, what conditions might show up. And we have weather forecasts and we have storage. And, there's nothing really on the horizon at the moment. I mean, this time last year, we're certainly facing much more extreme conditions. We'd had an incredibly hot summer and we were facing an incredibly cold winter. And it got cold fairly early. And so that spooked people. This year, we had a little bit of cold for a couple days, I think early this month, wasn't it? Well, you live in Florida. So you probably, but I mean, it did get down. I think it was like in the 50s out here on the East Coast. But I mean, it showed up a little bit and then it just retreated. And I think that's the one right now that everybody is trying to anticipate, right? They're assessing that we're at $2.25. The minute weather shows up, we'll get a reaction. And I'm a little skeptical of that this year, only because producers, storage owners last year wanted to protect what they had in the ground for fear of not having enough at the end of winter. This year, I think, and so that was like buy in the spot market now to save for later. I think this year they'll be more inclined to sell now, and worry about it later. And so the reaction might look a little confusing the minute we have some weather and we don't get these pops. I mean, it certainly can bounce from here, but I think there is going to be a different, mentality and approach in the cash market initially, which might set up in that way for some, calendar spreads. And a good one that I always like to look at is Feb versus March. I know everybody looks at March versus April, but that's really trading it's almost two different products. March is a winter strip product and April is a summer strip product. And in that way, it's almost binary. You hope that, people get bullish and they just buy that spread when it's bullish, but it doesn't even have a lot of fundamental underpinnings. But Feb versus March does, and in a few ways. Feb versus March in the East Coast and in some of the more constrained markets, you can see Boston and those areas are already, their spread to Henry Hub is $6-7 over. The same with the LNG curves, and that drops off in March. So there's a nice sort of Feb over March structure to the curve in some of the basis markets and in the LNG markets. And I think in Henry Hub, it's 7 or 8 cents, and it bounces around. It gets down to 3. I think last year it might have gone to, 30 cents. And that one I like because it has some fundamental underpinnings to it. It kind of speaks to maybe people not buying the front view contracts this year and maybe getting caught a little off guard as we round into January and February of next year. And it's much cheaper than buying options at the moment. And I look at some of these calendar spreads as a bit of a option to the upside. I know a lot of people like to argue about that, but in that way, for 7 cents versus you look at some of the volatility in these decent Jan markets and it's 50, 60, 70% already, just because people want a lottery ticket, but that implied vol, they're not even really lottery tickets, but they certainly have last year in their memory. And so they're, at some level willing to pay up, to play and get a repeat of last year. Although even last year, once the market ran up so much, you actually couldn't really even monetize a lot of those options unless you'd already been holding them. So in that way, sometimes you can be right and not make any money on some of these upside calls, but you can make some money on the spread. So I think going back and looking at, the conditions, the constraints, and cash, one of those needs to give a signal. We either need, a weather report, something different in the cash market, spot market that starts to point to something, or a constraint, like, a couple of years ago when, it's several years now, when the Aliso Canyon storage fire happened, and you don't know which one is going to come up, right? But to pre-position for that in such an overwhelmingly low demand period without the backdrop that we had last year, it's hard to say there's a price level that is 225 the floor, or could they pull the rug out from under you and all of a sudden you're 180? And who wants to take that ride? And I don't generally approach the winter in gas from the short side, especially at, before the season has even started, when all the unknowns are unknown. I don't generally like to come from the short side on that, but it doesn't mean I'm long. It might just mean I pick at some of these spreads, and, if we get a little more weather under our belt and get a little further down the process, certainly no problem going short, but I think it's too early in the season to say that there couldn't be a factor that we don't know about that comes in and moves this higher at some point. So anyway, yeah. So in that way, I'm watching all of these items pretty closely, and there's nothing that's a call to action at the moment.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. All right, well, let's talk. I want to talk a little bit more about your execution, but one thing that I want to bring up, and on one of my recent shows, Kushal, he had said, I expect natural gas to collapse big time. He said 4 weeks of injection above 60 BCF would be his trigger point to get short. What do you think about what Kushal said about his trigger point to get short?
Well, so here's the thing. I mentioned the difference in the mentality between this year and last year, and that's spot on right there, right? That is the underlying feeling and sentiment fundamentally, right? So if you were to look at the fundamental factors, we have 4 weeks left until the storage futures expire. Now, we could still inject beyond that, and it certainly looks like, given where we're at, that the 68 a week for the next 4 weeks will happen. It won't put us at storage levels that are, highest ever by any means. I mean, we've been over 4 TCF certainly before, but just continuing, inject that amount, have a comfortable on the high end level of storage without any new weather or anything out of the ordinary, of course, it's vulnerable. It's incredibly vulnerable to the downside. And that's the hard thing here is that do I want to sell it at 225 for a dump to $1.75, given where we're at the beginning of the winter? I certainly don't want to own it because I worry about natural gas is incredibly vulnerable to taking another leg down here for sure. But I think we're at max bear information at the moment, and it looks like that could happen. But I reserve the right to either let something political or some sort of sentiment change people's mind. And one of the things is crude oil. So that, if you've noticed, kind of, and it loosely is invertly, correlated, but it's really been kind of sticking to that lately. If crude prices go up, natural gas prices go down. And the reason behind that is the Permian. The production, the crude oil production there comes with associated gas that those producers essentially throw away. And because of that, all the other producing regions are having to, it's like a race to the bottom on prices here. So as long as you believe that crude oil prices will not fall out of bed, 45 plus, right, 50, as long as you believe that, then you feel comfortable that you'll continue to have this growth in this natural gas production that is a throwaway product in producing regions like the Permian. It's not the case in the Appalachian region because it's mostly they're drilling for gas, but in the Permian, they're drilling for oil, they're throwing away the gas, flaring it, dumping it on a pipeline. It's irrelevant to them except for, maybe getting them in trouble. So they're absolutely this time this year, we're talking about this real bearish undertone, whereas last year we were talking about this really bullish undertone, like a fear that we weren't going to have enough in the ground to make it through the winter. So I think he makes a great point. I can't argue with his bearish sentiment. I just, in a lot of ways, maybe that's why we're at 225.
I want to talk about you executing if something you see that you're interested in and how you would go about that. So we talked about your 3 C's: constraints, cash markets, conditions.
Yep.
You spoke about how you like to focus on trading Feb versus March as a spread. Give us an example of something that may come up, something that you're looking for that would be a trigger point for you to trade that spread and how you would go about trading it.
Great question, Anthony. Well, first of all, I like to build positions in the shoulder months, and October is certainly a shoulder month. And what I mean by that is it's like April and October are sort of the lowest demand months out of the year. And it tends to, market tends to drift off and be a little aimless. During that period, that's when I like to buy some of these spreads that I know react if some new information came into the market. So I think as of yesterday, or it was, it's 10, and then that spread was, down to 8, and I think it got a little below there. All the way down, I'll take in a little bit every day. I hope it continues to go lower. If this spread was at the high end of its range, I would be going the other way, right? But it's at the low end of its range. I recognize that it could, Feb could go under March, then I'll stop out, right? It gets to 0 and flat price and everything has turned bearish. I'll definitely stop out. But at 7 cents, 6 cents, 5 cents, those are, positions I'm willing to layer into that spread might not even move too much, even if we have the next leg down. And in that way, I feel comfortable about that versus trying to just outright go long or short at the moment. The minute we move into a bull price pattern, I'll look at outright length. The minute we move into bear pattern beyond the lows that we're at right now, I would consider sort of executing or looking at puts for next summer. I like when the market doesn't have any fear in it at the moment, things tend to get overlooked and they're cheaper. They get forgotten about. Everybody likes to talk about March, April, blew way out. I think now it's 18 or 19 cents. Personally, don't like that one because March always clears under April. But this is the time right now that if you are looking at seasonal charts and looking at, putting on some of these maybe option spreads or, calendar spreads, nobody's paying attention. So you can, get a position on. And that's really, it's hard when that, like I think when any market, right after oil, when the Saudi news came out, it was really hard to get anything on unless you were willing to start shorting, in the face of that. It was really hard to even execute long because the gap had already happened. And the same thing will be true in natural gas too, right? There will be something that will move us, and you just want to have some positions on prior to that, that could potentially be lucrative.
Hey everybody, I want to take a moment to thank one of our sponsors, FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures, contract symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Okay, besides focusing on your 3 C's, constraints, cash markets, and conditions, what other tools are you using? Are you using technicals or charts to help you execute these spreads?
I use a couple of things, Anthony. I use historical supply-demand data, and I like to look at relative value versus what months in particular have supply-demand imbalances. And there's a lot of good data on the EIA website, and you can do a lot of historical supply versus demand by months and get a sense for why some of these spreads come about in the first place. So in that way, I like to, look at actual data, and then I like to see where a current spread is trading versus its historical range. Doesn't mean I believe that it will stay in that range, but in a lot of ways, when prior to the winter starting, when some of these, let's call them bull spreads, and this isn't me saying I'm bullish, but I like to look at where they are in their relative 5-year historical range during the shale period.
Yeah, it's just having awareness, right? You want to be aware of
right.
the range.
You're right.
Now,
right.
I want to talk about a few things because I don't trade spreads, so I'm always curious about how people put stops in if they're trading spreads. How are they determining position sizes when they're trading spreads? And then if they start going your way, do you have targets? I mean, how do you know when to get out of these things?
So, for example, we can beat this Fed March to death, but, in oil markets, there's, the market's been in backwardation for a while, and now it's flipping into contango. Those markets, you might have had a target of that flip, right? And once that flips, you've made your money. In gas, if you look at a spread, you enter it, you decided that unless it breaks down below its, sort of historical range or something's changed fundamentally, and this is not going to be the year that it follows course. Certainly get out. It's harder to put stops and spreads, but they're also less volatile. On the upside, say my first target is generally recovering sort of what I've initially put in, right? So if I averaged into a spread at 7 and we've moved up to 14, let's just call it doubling. And that's in a world where the range has been between 0 and 35 cents. I certainly take half off, and depending my belief on the bull bear sentiment in the market will come into play on that, right? So if natural gas rallied, the event is over, and the spread, only gets to so far, I might take it all off. But spreads are a bull bear sentiment, and so if you believe a bull run will continue in outright markets, and the spread is acting differently, there's a lot of information in there, right? It tells you there's something else going on. So I think I can't give you like a perfect answer. I'm definitely a position trader, right? If I fundamentally like something, I'll have, put it on, I'll hold it until it's breached some stop loss. And then on the upside, I like targets of, especially on these spreads, right, to double. And beyond that, you really have to, it's a bull bear thing. So if I'm no longer bullish, right, or no longer bearish, I'll get out of it.
No, that's a great explanation. Thanks, Brynne. A couple of topics before I let you go. I want to go to some of the headlines that came out over the weekend, actually. One was Iran announced on Sunday that it has discovered a new natural gas reserve with the capacity to produce nearly 400 million barrels of gas, which would generate a total of $40 billion. Big deal, not a big deal? What are your thoughts on that?
I think that goes back to talking about the potential supply that appears to be out there. And also, it is Iran, right? But that people are looking, it's a race right now to be a supplier in the global markets, not just for oil, but, fingers crossed, people want that in LNG. So a reserve is meaningless until it's produced. And I can't comment on whether or not they would produce it, but I think if you want to file that in the back of your mind with we're certainly not running out of natural gas, that would go in that file.
Last question for today. On September 4th, CME put out a news release that on October 14th, so actually last night, they're going to launch the first ever physical LNG futures contract connecting global gas market participants to U.S. exports. Thoughts on this new contract?
Well, there's a lot of good information that will be in the settlement prices and the market action on those. A Gulf Coast LNG price, that will clearly define what the spread is between conventional gas, right? So Henry Hub natural gas, and refining it into LNG, right? Tolling it, they say. It would be like having the crack spread at some level, right? And I think that'll bring a lot of transparency to the market. There's a lot of fat margins that have been out there on, for first movers getting into this market, since there's not a lot of price transparency, and even on sales contracts. So we'll kind of start to see that. I'm going to liken it to a crack spread, but it's the fractionation spread. And that will be good. I think we'll see how, short or long the market is. So I like it from that standpoint. And then, the next piece of information it will show us is the export economics, right? So once you've fractionated it and you've got it as LNG in the Gulf Coast, that's that price, right? And then you look at the Asian LNG futures, the JKM that CME already has. And you can see it's like the Brent WTI spread, right? So now you start to see what is that what's the demand for that, and what's that relative to shipping costs? If it's not covering shipping costs, you tend to think there's not a lot of demand. So I think that's going to bring in a lot of just knowledge that hasn't really been there around this whole LNG era that we're in this export era. So I welcome it. I'm certainly looking forward to it, and I hope it brings in a lot of sort of spread trading in that way. That's kind of the way we get connected to the global markets. Right now, we're not really, but it's, as in, crude oil is certainly unarguably connected to the global world, even though we have our regional dynamics. I think that, that's a step in that direction to sort of move natural gas out of a local product.
Brynne, it's always great to hear your insight. Where can people follow you on Twitter, and give us a website to check out?
Twitter handle is Brynne K. Kelly, and website is thefundamentalangle.com.
Terrific insight today. Thank you so much for joining me on Futures Radio Show.
Thanks for having me, Anthony.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.